See, and somebody from Tampa. Good morning, Tampa.
Nice.
All right. Well, I will get started. It'll take me just a couple minutes to get through a few introduction slides, give a few more people a chance to sign in. Good afternoon. My name is Leola Carter, and I am your host for today's webinar. I am a SCORE mentor in the Minnesota division, where we have over 90 volunteers serving both Manatee and Sarasota counties. I am also on the education committee and excited to bring to you today's presentation on business finances with Frank Maggio. But first, a little bit more about us at SCORE. We are a nationwide nonprofit organization that's an independent part of the Small Business Administration. Oops, well, and then I messed up that slide. Let's see, we'll go this way. All right. What SCORE can do for you? We provide free mentoring and educational services, such as this webinar. We can help in all stages of the business process, from that first initial thought up through when it is time to sell. You can find us at score.org/Minnesota, where you can request a mentor or you can apply to be a mentor. And today would not be possible if it weren't for our sponsors, such as BayFirst, today's presenter, and other community partners that we have listed here. And now I believe it will be time to introduce Frank Maggio, who was born and raised in Southwest Florida, has over 20 years experience of banking, is now vice president of BayFirst, and specializes in a full range of services, including commercial lending, consumer, residential, SBA products, and including 100% financing. And if I don't mess up my stop sharing, we'll get ready for Frank to be able to share his screen and take it away, Frank.
Thank you. Thank you, Leola. Let me see, share screen there. Everybody can see my screen. You can see my screen, Leola?
Nope, not yet. I
It's
hear
because I didn't hit the
you.
share button.
Oh,
That's why.
I do. I
Now
do
you can see
now.
my screen, right?
Yes, it does have tools and such around the outside, but I can see it clearly.
Gotcha. I wonder if that. Okay, there we go. So thank you for the introduction. So my name is Frank Maggio. I work for BayFirst Financial. I was born and raised in the Naples, Florida area, which is Southwest Florida. Educated at Florida State University. Sorry for anybody in Florida if that offends you. Moved here to Sarasota in 2001. My first day in banking was the Thursday before that Tuesday in September of 2001. That's how I will never forget that. And most of my career has been spent on the underwriting and also the lending side, so the sales production side for commercial lending. I do have a fair bit of experience in both consumer, residential, and also a little bit in SBA as well, or small business administration. BayFirst is a local community bank. It is based out of downtown St. Petersburg, servicing the Hillsborough, Pinellas, Manatee, Sarasota, and surrounding county areas in that Tampa Bay market. The bank is a community bank, but it is a national bank. It is publicly traded. We actually just made that change right during the pandemic. It was actually just now about 2 years ago where we went publicly traded, but we are still a community bank. And I just wanted to mention that one of the services, or at least one of the areas that I mentioned, was SBA. We have a product right now that may be of interest to a lot of small businesses. For those of you who might be familiar with SBA loans, called a 7A loan, we're specializing in a small product for businesses that have been at least 2 years in operations and profitable, called a Bolt loan. That's just something we're calling it. It's a maximum of $150,000 to a small business to assist with working capital. And if that's something of interest, we have more information on that, and Leola has info, on how to contact myself or anybody at the bank, but certainly to contact me. So think that's all I have for introduction. Is there anything else I should cover, Leola?
No, I'm just typing into the chat the information that they would be able to directly be able to look at the information for that Bolt loan. So I will type that in. And just to let participants know, if you do have questions for Frank as we go, if you could type those into the Q&A, we will try to get those answered. We'll probably answer a few as we go and hold just a few down to the end. And anything else that you need from me, people can type into the chat and I will try to answer those as we go along as Frank's presenting.
Yes, definitely. Thank you. And I mentioned to Leola earlier, she can interrupt me anytime. I'm going to try to, in between slides, kind of leave a few seconds. So if anybody does have a question, like Leola said, just please type it into the chat. But Leola definitely, interrupt me if anybody has something relevant to a slide that I'm on at that moment or had just left, and I'll be happy to go back to it. So I'm going to start with kind of the basics. So everybody on this call, I'm just going to assume is a business owner or is looking to become a business owner. And in most cases, especially, in either one of those cases, you might be looking for a loan. And in most small businesses, that usually comes in the form of assistance of either starting up the business or keeping your business in operation, which is kind of the point of what I mentioned about a Bolt loan, or which is just a fancier way of saying an SBA 7A loan. And so I'm sorry, one second. I had somebody message me, so I'm just responding. So the process is pretty similar, whether you are looking at a business loan or a personal loan, for saying buying a home or in a car loan, things like that. So the process is only a little bit different, only because you're dealing with a business operation and you have business owners. And in most small business cases, usually with the way that looks is just a pretty simple structure of a loan, or excuse me, a business, and then you've got one or two owners. In a lot of cases, they might be like a married couple or partners, one or two, or in a lot of cases, there's just one owner. A much simpler, structure, either a sole proprietorship or just a single owner entity. But the process is basically the same, whether it's a business or if it's even an individual. So there's an application, there's financial statements, which for a lot of people, when I say financial or a bank says financial statements, what most people typically think of are tax returns, which is one of those little honeycombs below the business financial statements. But I will kind of go into a little bit later about the difference in what everybody thinks of as financials as tax returns, which I think everybody knows what tax returns are. But also financial statements and the importance of the difference in those two, and why a bank in the process of applying for a loan is going to ask for those. Personal financial statements, which are actually very similar to the business ones, they're just talking about your personal information. Again, I'm going to go into that a little bit later. Verification of assets, detail of purchase assets, business plan, credit score. Those are things I'll go into a little later, but those are typical things that you as a business owner are going to be requested in the process of applying for and being approved for a loan. Financial statements. So I mentioned this a little bit ago, that financial statements are, and just so everybody's aware, I'm not really going to read verbatim off of every slide, but I'm going to use it as a tool. But this is a way of proving to a bank and showing a bank, how you are operating, and the importance in it. And this is where the difference in tax returns and financial statements comes into, is that you have a tax return is only going to be dated year end. And in most cases, like for example, right now, the bank, if you are applying for a loan and we are considering you for a loan, we are going to have outdated information. And in this case, being middle of October, at least 9 months outdated. So receiving financial statements, which are typically income statements, balance sheet statements, that's the typical pairing of business financials that a bank will request and a company can provide, is a good way for us to figure out, well, how is the company doing more recently? It's great to have tax returns. Those have to be audited or at least reviewed by a CPA for the most part. Yes, it's possible for an individual to file their own business tax returns, and particularly if you're a sole proprietorship, you don't have to file a separate tax return. you can file under what's called Schedule C under your personal tax return if you were a sole proprietorship. But in any case, the bank is going to want financial statements to get a little more current and updated information. Additionally, how financial statements can help, because we're looking at something that's more current, is by looking at what we call comparative analysis. And what that means is that if let's say, Leola, you're a business owner, which I know you are, and you're applying for a loan, and I receive from you tax returns, but I also receive from you a January through month-end September year, or what's called a year-to-date month-end through September financial statements, income and balance sheet. I also would ask what's called a comparative, meaning that you would also provide me that same term for January through September of last year, of 2022. And what that will help me and the bank is to understand, well, how did that business look through 9 months of last year? And how did it end year end with the tax returns, which by now they should be completed. Most federal tax return filings were due in middle of September. Although for those of you in Florida, technically you could your CPA could grant you an extension because of Hurricane Idalia, until I think it's the middle or beginning of February of next year. But the point is that we can tell from those mid-year last year financials and the year ends, and then we look at this year's mid-year through the same term and figure out, well, how is the company comparing? So there are importance of asking for financial statements. Third thing on here, which is cash flow, that's ultimately what's repaying your loan. So any loan that a business is requesting from a bank, the cash flow of that business, that's ultimately what is repaying us, not the assets. Although in some cases it is the assets, and primarily that would be things like real estate holding companies, because their primary operation is real estate, and usually it's the buy, sell, and also rental of real estate. The big three, which I've already gone over: income statement, balance sheet, cash flow statements. Typically, you as the customer aren't going to be providing a cash flow statement. However, if you are working with a CPA or a savvy enough bookkeeper, they will prepare a cash flow statement for you. And then essentially, and I'm going to go into it here now with cash flow statements, kind of what that is. It is essentially how the company is converting its assets and its operations into actual cash. It is your cash flow. Now, typical cash flow, very what we call in the banking industry, what we call kind of down and dirty, cash flow analysis, would essentially be taking your net income, adding back any non-cash items, and coming up with what, if any of you are familiar with this acronym or have heard it before, is called EBITDA, EBITDA, which is earnings before interest, taxes, and amortization. That is a kind of down and dirty way of telling how much a company is actually producing in cash flow on an annual basis. In the case of if you're using a tax term, if you're using an interim financial statement, it's through how much ever long that is. So in my example with Leola, that would be for 9 months, let's say. Help me the cash flow money. My marketing department put this together, so I always kind of chuckle when I look at these things. I have a creative mind, but I'm always interested in how they put things together. Cash flow statements, an actual cash flow statement, which in the industry you might hear it called, if anybody's ever heard of this, called a UCA cash flow. That is a statement which encompasses these three activities, which most every business has. Operating activities, which is pretty understandable. I think everybody probably understands what that is. That's your operations of your actual business itself, whether it's converting, or whether it's, if you're a service company and you're doing a service for somebody, like say an attorney office, and you're providing services, or if you're a widget making company and you make something and you sell it, so you've got cost of goods and you have to sell it, or whether you're like a real estate company where your operations are buy, sell of real estate or lease activity. Investing activities, for most companies, this is going to be pretty limited. Usually it's going to entail your interest and dividends you're making if you have them, if a business has them. If you're a C Corp, you might have dividends, although you're paying them out, not getting them. most companies that you're going to have large investing activities are typically going to be real estate companies because they're buying and selling real estate. But other companies can sell equipment, dispose of things. That would be investing activities. And financing activities, that's where I come in. That should be obvious. That's your paying off and also taking out debt, whether it's through a bank or even a private source. This is what a typical what we call in the industry a UCA cash flow, or just a typical cash flow statement would look like. This is something that a CPA could prepare. This is actually something that in the bank, when we're underwriting a loan for approval, we can produce. So you as a customer actually, usually the bank is not asking you for a cash flow statement. By taking a tax return and financial statements, interim or annual, we are able to build a cash flow statement. We have software that inputs financial statements and actually comes up with this. And basically a cash flow statement in a nutshell is what you get when you take a income statement and a balance sheet and you marry them together, because you are trying to take information on the balance sheet, things like your cash at beginning of year and end of year, your accounts receivables and payables if you're an accrual-based business. If you're not, if you're a cash-based business, then you don't have accounts receivables and payables, but you may have inventory. You may have goods that are finished that are waiting to be sold. If you're a service business, that doesn't necessarily apply. So if those things apply, then it's taking those non-income statement items and converting them to a statement so that the reader can understand, well, what is the actual cash flow of the company? So back to my original example of EBITDA, that is a very down and dirty way of looking at cash flow. You're just looking at what's produced actual cash to the company, revenues, sales, which is usually line 1 of the 1040, or the first line of the Schedule C if you're a sole prop. And it's then working out any expenses and coming out with a net income. And then we just add back what we call non-cash items, which would be interest, depreciation, and amortization. Now, technically, interest is a cash item. The other two are technically, but they're really items that are taken from an IRS tax code, which gives you, the owner, the ability to lessen your net income, which you ultimately, as an owner, especially if you're an S corp, sole proprietorship, LLC, you have to pay the taxes on the income from that company. But those non-cash items, including interest, are things we add back, because that ultimately, that net income plus those add backs are what you as the business use to service debt. UCA cash flow, or this cash flow statement that you see on the screen, that number gives you an actual number of cash flow, because in some cases with a balance sheet statement, you may have receivables, payables, or receivables or payables, or also inventory change where actual cash has been used. And that is really a better way of determining what actual cash flow of the company is. For example, your company may have made money, but you may have had to, at year end or before year end, outlaid a bunch of cash to purchase inventory so that you can kind of ramp up, quote unquote, for next year. Well, that would actually be cash out of your company, and that would affect your cash flow, which is kind of what this statement is showing. You've got net income, you've got depreciation, you've got liabilities, which is where your AP comes in, and then you've also got some receivables above that as well too. Investing activities here, they've got marketable securities. A lot of this stuff you're not necessarily going to see, but is possible for a business to have. Again, it's also got purchase of property equipment. That could be physical equipment for this business. It's a bakery, so they could have purchased something they needed. And then there's obviously investing activities. So it's actual cash that's used to repay debt. So there's where the amortization comes in. The interest doesn't really come into here typically. It's usually an additional line item below the actual that bottom item where it says increase and decrease in cash and cash equivalents. That's the actual cash flow. So this company on an annual basis in 2022 actually cash flowed a little over $21,000. Whereas as traditionally, if we look at it as an EBITDA, we would have taken that almost $6,500 number on the net income and added back depreciation, amortization, and interest expense. Now there's no interest on here, so I can only assume what the interest would be. But given the fact that there's payments on long-term debt under the financing activity of $20,000, I would have added that back. So that would give me close to $25,000. I could assume the interest would maybe a couple $1,000. So you're looking at maybe an EBITDA of around $25,000 to $30,000. So you can see there is a vast difference between those two. But that's a longer-winded way of saying that there are several ways the bank uses your financial information to make decisions on a loan. The balance
Frank, I
sheet,
do.
which oh, go
Sorry,
ahead. I'm
I do
sorry.
have one question in the Q&A right now,
Go
and this
ahead.
might be a question for an accountant, but I will throw it out there anyway. Keo wants to know if he makes less than $24,000, do they still need to file? So, like I was thinking, probably an accountant question, but I thought I'd ask you just in case.
Yeah, it is. It is an accountant question, but as a financial professional, I have to kind of wear many hats sometimes, and I have to talk with a lot of CPAs and attorneys and others. So I have to somewhat be a loose expert on these things. There is a minimum requirement for having to file a tax return. There are also even minimum requirements for needing to file balance sheets in your tax return. So if you actually do file an 1120, so a separate tax return for your business, I believe the number is $250,000. If your revenues are even under $250,000, you don't even have to file the balance sheet portion of the tax return. Now, don't quote me on that, but I think that number is about that. As far as a minimum revenue for actually filing a return, as far as I know, I think whether you make $100 or $5,000 or even $5 million, I think you still have to file some kind of business return. Now, if it's a smaller amount, I'm sure the government's never going to know, as long as you're not showing yourself in any way to the government, meaning you don't have any extra receipts. If it's cash under the table type of situation, that's a whole different situation. I mean, your daughter or son that runs a lemonade stand, technically that's a business, but I mean it's a cash business, so I don't think the government's really going to care about Susie or Tommy running a lemonade stand. But I think there are minimums. But at the end of the day, Leo's right. You really should seek a CPA, a tax professional, somebody who is certified to answer that kind of a question. But that I can answer, I would say that really there is no minimum that I'm aware of to where you actually have to file a tax return. What I mentioned earlier, though, is that a lot of sole proprietorships, if that's the case in your situation, the person that asked the question, if you are 100% owner of that company, you don't necessarily have to file a 1020, which is a separate business tax return. You can just, when you file your personal tax return, file a Schedule C, which is an additional schedule under your personal tax return, which encompasses all of that income information that I kind of went over, everything from your revenues to your expenses, and you get a bottom line number, and then that flows through to the front page of your personal tax return, and that's what you ultimately have to pay taxes on based on that income. Hope that answers your question.
Excellent, thank you.
You're welcome. So the next part of the statements is the balance sheet. The biggest point out of all of this slide is that, if for everybody to understand, it's a single point in time. An income statement, is a range because it could be interim, what we call interim, which would mean like say January through September month end. Most companies usually their calendar year, their financial year starts January. That's pretty standard, but there are companies that start at mid-year. But for the most part, it's usually January through, and that's an interim. And obviously that's a range. And if it's year end or a tax return, that's an entire 12 months. But a balance sheet is a point in time. And where that's important to understand is that when we get that range in the income statement, we also need that same point in time for the end of year or for the end of that range. And we sometimes would ask for it for the beginning of that range so that we can see how that cash changes. And that's where a cash flow statement is generated, because again, it is marrying that range of information from the income statement and also marrying it or pairing it up with the point in time for the balance sheet, because it's checking the changes over time in that balance sheet from point A to point B to point C. Typical cash flow statements are not just 1 year; they're typically 2 and 3 years at most. And to be fair to a company, and from a standpoint of approving a loan, fully underwriting, understanding a company, and approving a loan, 1 year of tax return or financial statements is never enough. You typically need 2 to 3 or 3 to 4 years. Really, 3 to 4 years would be better, because that gives you a true trend analysis to understand what's going on in the company. And obviously, right now, that can be difficult for some companies, just because 3 and 4 years includes the pandemic. So in a lot of cases, just speaking from experience, and we did very similar things in the banking industry during the last downturn, now 16, 17 some years ago, and also even after 9/11, was asking for information even prior to that major event. just so that the bank could understand, well, how did the company operate prior to this major event, and how did it operate during it and after? With the pandemic, that is a very real life example of what's going on even right now. A lot of loans that I underwrite, I'm asking for 2019 through 23 information, because that at least gives me a full year prior to the pandemic, and then obviously 2 years during it, and at least one full year after, quote unquote, the pandemic was over. These slides are just kind of stating the obvious of what's on a balance sheet. Assets. I think assets, everybody understands what that is. Something tangible, although for a business, it can also be something not tangible. You know, the value of the company. If you have a patent, you know, if you own something that is not necessarily tangible but actually has worth. For most companies, usually the worth in their company is on the liability side, and that would be your owner's equity, which is the offset of how many assets you have minus the liabilities. These are examples of assets, a lot of which I've already mentioned, and you can see in number 2 that intellectual property. That's the non-tangible thing. Most banks, commercial banks like myself, or the bank that I work at, and what I do in commercial lending, we typically are looking at something tangible to attach ourselves to. But those of you that are familiar with the SBA or their products, that is particularly why the SBA exists, because they're typically helping with things like working capital, which are non-tangible, but tangible in the sense of they could be for things like hiring an employee or keeping your employees on staff. During the pandemic, those payroll protection loans, that's exactly what those SBA loans were. They were 7A loans for working capital purposes for you as the business to stay afloat and stay open. You're paying your employees, even though you weren't probably able to operate, and you didn't want to let them go, and the government didn't want you to let those employees go, so they wanted you to kind of keep them on staff, and that's what a lot of that's for. And not just pandemic related. You know, if you're a business and you're looking to start up, or if you're looking to keep in operations, you need some cash to hire more employees or to expand, maybe to you know, go into a bigger location and your lease is going to increase. Again, those are all non-tangible items. It's not real estate. It's not equipment. Those are eligible for SBA financing, and that's particularly what SBA financing is for. Although SBA financing can also assist with equipment and real estate as well.
I have a question from Dimitri. They want to know, how exactly is insurance considered as an asset?
So insurance that's term insurance is only considered an asset in the sense that it just lets the bank know that you do have something that would kick in should you be disposed as an individual. In a business situation, that's actually very important, because if there are loans to the company, an insurance policy, which in many cases what's called a key man life insurance policy, is important, because if you're the only owner of the company and you were to decease, then that life insurance policy would kick in, and in some cases the bank may take security of that life insurance policy. Now, in most cases, it's an asset, particularly because you would be looking at the cash value of life insurance, which would be for a whole life policy, not a term life policy. Probably one of the biggest misconceptions or errors that I'll see in borrowers is they'll tell me they've got $1 million life insurance policy, and they'll put it on their asset and balance sheet. They're on their balance sheet as an asset. And probably one of the first questions I'll ask them is this a term life policy or is it a whole life policy? And typically the answer will be a term life policy. There is no cash value in a term life policy. It's a premium you pay in. Should you die, it kicks in and you get $1 million, and that could probably take care of all your debts. But in a whole life policy, it's earning dividend and it's actually earning cash value. Typically, they'll be for a little less than a term life policy, but you're building value. It is a investment vehicle. Either are investment vehicles, but one will actually build cash value. So that's the biggest difference in why it would be considered an asset. But either a term life or a whole life would be considered assets. It's just how it's treated, and both can be used for equity, or both can be used as collateral for a loan.
Excellent. And just one more thing, if I can ask this, just a few seconds ago, is a profit and loss statement acceptable versus a cash flow statement?
Yeah, so an income statement and a profit and loss statement they mean the same thing. So that I made a comment earlier. Most banks and most borrowers, companies are not going to be requested to provide a UCA or a cash flow statement. What a bank will ask for is an income statement or profit and loss statement. They mean the same thing, and a balance sheet, and along with the tax returns, which a tax return, if it's a 1020, provides you both of those things as well. The front page of a 1020, that is the profit and loss statement. And usually you have to turn about 2 or 3 pages in, and that's the balance sheet because it gives you the assets and liabilities and owner's equity. So that's a great question. That's an interchangeable term that bankers often will use. P&L, profit and loss, IS, or income statement. They mean the same thing. Bankers, we love our acronyms.
All right, great. Thank you.
Yeah, welcome. So assets, again, current, non-current, this is really just going into detail. Liabilities, I think that's pretty obvious. I don't think I have to go into that, what liabilities are. I think everybody probably understands what a balance sheet statement looks like. And let's see, key factors of liability. Yeah, this is the importance of this slide is just to really drive home the point that as bankers and as financial professionals, we rely on these statements. So I could go into nauseating detail that would last longer than this seminar about how I have worked with some very challenging customers and some very savvy customers. And at the end of the day, if I'm provided financial information that's on the back of a napkin or is on a piece of paper written out, not that should be discounted, but that the relevance of that or the accuracy and reliance on that is paramount. So, if you're a company that's say 250 or 500,000 in revenues and under, I would even say $100 to $250,000 in that range and under. You could certainly get around and get away with, say, working with a bookkeeper or somebody internal that works for the company, somebody that you've hired that, maybe isn't a CPA or an accountant, but, does have basic understandings of accounting or financing or finance in general, excuse me, that can work with QuickBooks and similar type of programs that can help put together very basic financial statements like a profit and loss and a balance sheet. But if you're much larger, certainly doing $500,000 and more, especially over $1 million, you need to be working with a CPA. As much as, yes, that costs money, if you're going to be working with a bank and asking for loans and financing, especially through the SBA, you need to have tax returns that are prepared by a certified public accountant. Looking at tax returns that are self-prepared for a company that makes $500,000 and especially $1 million and more, the bank immediately is going to question the accuracy of those financial statements. That is just a fact of banking in the world we live in. My 23 now years of bank, or excuse me, 22 plus years of banking now, I've seen just about everything, and I've seen companies that are very large in revenue and prepare their own tax returns, and how a bank will just shy away from that. But I also see I've also seen the good side of it, where a company that is making a lot of money, even $500,000 and more, or even $250,000 and more, $100,000 and more, using a CPA, and how that takes that responsibility and that headache off of the owner's plate and moves it more onto somebody who is paid to do that work and to provide the information that is necessary, which ultimately can be used by a bank or even a creditor. If you're a business that's making widgets and you need inventory, a lot of companies that provide your inventory or your materials or raw materials may ask for credit reference information, which is essentially what a bank is doing in approving you for a loan. It's not as long and drawn out as that, but it's asking for a lot of similar information. So there is importance in working with accounting professionals, and there are a lot of professional bookkeepers. You just have to be careful with some of those, just because they're a little fly-by-night sometimes, and they're not necessarily registered or certified. But there are a lot of accountants that even provide bookkeeping services that aren't charging as much as what a full blown reviewed and audited statements. If you're in the 5 million, 10 million plus range, you need to be getting audited statements. That's pretty much a standard with banking, and really a standard in most businesses. You don't want to be producing that much in revenues and just relying on a individual CPA, somebody who just graduated from college. And I'm not trying to pick on the CPA industry, but it's just a fact of working with a professional firm that's got a lot of experience. But the relevance and importance in doing that. So there's a lot of key factors in why financial statements are relied upon. The income statement, I've kind of gone over most of this, but as you can see, the bottom line, which is kind of the bottom line, is the profit. Revenues, expenses produces profit, and here's where EBITDA comes in. And that's, I've already kind of gone over this. Your sales revenue minus your expenses, and we add back some of these items, the depreciation, taxes, interest is not mentioned in here, but that's one of the items that's really the I is the of the EBITDA, but that is what we're primarily using. But we also use cash flow statements to really understand how the company's cash really flows. Sales revenue, operating on. I'm not going to go into a lot of this unless you guys have questions. If you're a widget making company, or you actually have, cost of goods, a lot of, I'd say 50% or half companies or so don't have cost of goods. If you're a retail company, you may, because you might have some goods that you have to purchase, but primarily you're just wholesaling or retailing, something that you're purchasing from somebody else. So there's your cost. Widget making companies, somebody that's actually physically making something, like a construction company, that's definitely cost of goods. If you're physically making an item that you're selling on the open market, or whether it's to a retailer or wholesaler, that you've got cost of goods. Service companies typically don't have much of cost of goods. Typically that's either zero or there's very little. Most of your expenses for service companies and the like, they're fixed and variable costs, which I'm going to get into here in just a second. Gross profit, net profit. The biggest difference in that, really the reason why that's important is we're trend analysis. We're doing trend analysis and also industry analysis against those things. So if you have cost of goods, your revenues minus your cost of goods is your gross profit. And then from there, you take your variable and fixed rate costs, like your overhead, meaning your employees, maybe your lease expense, or if you own the place, your expense of owning that location, so your taxes and insurance, things like that, any other variable costs. That's what drives your net profit, which is the next part. This goes into some details of what the drivers are for gross profit. I'm not going to go into the detail of that. Operating expenses, also called SG&A, that's your fixed and variable costs. That's, again, your depreciation, employee wages, which is overhead, supplier payments, commissions, pensions, whatever. I mean, there's a bunch of things that go into that. And this is where I mentioned fixed and variable costs. Your fixed costs are things like your overhead. You have a lease payment. You're leasing something every month for a year, and you've got a term. That's a fixed cost. It might go up because there might be increases, so it might be quote unquote variable in some cases, but it is a fixed cost. It's something that's not going away unless you make it go away. Same thing with your overhead of your employees. Variable costs are all the other items. Your insurance is a variable cost because that goes up and down every year. That's not something you control, other than quoting it with other agents. Your net profit is minus all of those things. Your total revenue minus all your expenses, including cost of goods, and that's your bottom line. And that's ultimately what the bank is really looking at in these financial statements, is that bottom line number. Whether it's from a traditional EBITDA situation or standpoint, or if it's from UCA cash flow, which is the reason why we ask for full financial information, including your interim year income and balance sheet information, or profit loss and balance sheet information, in addition to your tax returns. So that's really the end of it right now. I really want to try to drive more questions. We've got, let's see, it's 12:38, and we've at least got, what, 20 more minutes, right, Leola?
Yeah, so I do have a couple in there. So when I brought up the previous question, is a profit and loss statement acceptable versus cash flow statement? I already asked you that one. And when you were answering, you definitely alluded to profit and loss statement is kind of interchangeable with operating statement, or at least I definitely use both of those terms. But I didn't really know if you, and maybe it was just me not paying attention 100%, but if you said like profit and loss statement versus cash flow, because to me those are very different things.
They
but
are.
some
Yeah,
other people may think that
yes.
they're interchangeable, but to me they're not.
No, they're not. No,
I thought I'd just re-ask that question.
And actually, I'm sorry. Let me go back to sharing my screen, because then what I'll do is I will scroll back to the profit and loss statement itself. So that's the balance sheet. Profit and loss statement was right. Actually, this slide is perfect. I know it's tiny, so I'm not sure if everybody can read it. But actually, I might, because I've got this. I'm actually not using PowerPoint, Leo. I'm using my, I can scroll in perfect. Okay, so
nice.
this is perfect because this actually shows me This is what a profit and loss, and this is very, very watered down, but this is what a profit and loss or income statement looks like. Net sales, if the company has cost of goods, there's your gross margin. Here's your variable and fixed rate costs, your operating expenses. Here's your operating income. There's your net income, which unfortunately this gentleman's elbow is blocking it. And actually, this is great because this shows a comparative. So it shows your current and your previous. So let's just pretend this is January through September of this year, and this is January through September of last year. So this is great. This is an income statement or profit and loss, which shows me the current and previous years, which is a comparative situation. Now, you can't see the numbers, but I think everybody gets the idea. This slide also, whoops, scroll back. This slide also shows what a cash flow statement looks like, which is vastly different than the actual income statement or profit and loss. It does capture some of the same information, but what it also does is capture, and this goes back to my comment about what a cash flow statement is, it is a marriage between the income or profit and loss statement and the balance sheet. So this shows in operating activities, it shows net income, and this is even better because this shows me the current previous, but it shows the net income for the current and the previous, and it also shows adjustments that are made to operating, investing, and financing activities. And these are balance sheet items. Changes in operating assets and liabilities, that's a change in your balance sheet. This is saying that there was an 890, and in most cases, usually when you see these statements, this is just a thing with bankers. We usually round this, so a lot of times these are in thousands, but let's just pretend this is in actual common dollars. So it's $890. So that means from January, and I'm just going to, in this example, say through September 30, there was $890 of difference in the change in your assets and liabilities. Now it's a positive number, which means that your assets grew, not your liabilities. If it were a negative number, then it would be the reverse. But this is adding to your actual operating activities and your cash flow. And then you're taking from that, or in this case, I'm saying you're taking from it because you had investing activities that were negative. Your marketable securities decreased, or you paid into it, and your property and plant and equipment, or PP&E, also decreased your cash. Whether you purchased something, you disposed of something, and it caused a loss, whatever the case is, now if you purchased something and you financed it, that would be down here under financing. But this is to say, this is all taking that flow of cash and giving you a bottom line number. Now, unfortunately, this is not as great because it doesn't give you that bottom line number. But to get to that bottom line number, you would take this 3,500 minus out the 1,100, add the 2,200. So you're looking at around 5,700 and change minus 1,100. So you're about 6,600, 5,600, sorry, 4,600 in cash flow for this current year. So that is vastly different than what is showing on this income statement, although we can't see it because this gentleman's elbow is blocking it, but that is the difference in those two statements. So yes, they are vastly different.
Fantastic. I have another question, and I might talk about it for just a few seconds. They weren't positive if this was the great, perfect venue to ask this, but it says, how do I know that I have the right CPA? When should I switch my CPA? What should I expect from my CPA? And how quickly should they be getting back to the business owner? So I don't know if Frank and I can answer these questions specifically for you, but I can give you a little bit of information about my CPA. I feel that they are very particular, and they request a lot of documentation from me. I mean, a lot. So pretty much every single thing that I do in my business goes to the CPA. But what the CPA does for me is they said they've got my back come auditing time. So that's what I am paying for with my CPA. Somebody that is so thorough and so precise that, heaven forbid, I get audited, they're going to go and take care of that for me because they are so specific. And as far as how quickly should they be getting back to you, I have another example of that. If I don't get my operating statement and my financials and all of my information to my CPA until, let's say, April 5th or 10th, well, they're not going to have my taxes done on April 15th. So it's just, when you get your information to the CPA, I would expect, a reasonable time frame. But you've also got to remember, January through April, these people are busy. That's when they do all of their business. So if you maybe don't think that you're hearing from them right away during that time frame, that's probably because they are working on all of their clients. However, if you're messaging them mid-July and there aren't any corporate tax returns due and you don't hear from them for 2 or 3 weeks, well, that wouldn't work in my business. Let's say that.
Very, very true. Yeah, I mean, everything you said, I would certainly echo. I would simply add to that, your CPA is obviously a professional. They are no different than you as the company. They are also a company. The bank is a company as well too. In fact, probably the biggest thing I always find, I always have a chuckle with when I talk with. I mentioned I graduated from Florida State University. I do shadowing pretty much 3 times, 4 times a year, sometimes with students. And one of the first things I kind of hit them over the head with is that, hi, I'm Frank. I work at a bank, and guess what? We're a business. I think a lot of people think of a bank as a service that is necessary and that it has, that you have to get. Where at the end of the day, no, we're a business. We have profits and we have shareholders, whether we're publicly traded or not. We're trying to manage our bottom line just like you as a business is trying to. It's just that we make our money through making other people money or helping them make money. Our assets are your liabilities. Your assets are our liabilities. So the cash you put in the bank is us. And CPAs are no different in the sense that they're like us. They have to make money and they want to make money and they want to. They're feeding mouths and they hire people and they feed them and they're subject to the same scrutiny that we're subject to and that you as a business owner be subject to. So if you have a CPA that's not working for you, there's Better Business Bureau and there's other things you can go out to. And that's actually good for you in the sense of the consumer because you can go out and figure out who the best CPA is for you to utilize. One of the things I think I always try to explain to any customers that I introduce myself to or I have the pleasure of doing business with, is having that kind of close knit business professional audience that you can ask questions and constantly bounce ideas and ideas and questions off of a banker, a CPA, an attorney, a realtor, those type of individuals, depending on what your business is. But a CPA is definitely important, and you can go to chambers of commerce and there's even certainly every state has professional business search capabilities where you can look up and see if an accountant actually is certified in that state that they're operating wherever you're located. Those are things that you can do as a business owner, kind of your own due diligence that you can do just to make sure that you're working with a true professional and somebody who is licensed and knows what they're doing. But it is very important. It's as a business, working with a CPA or working with an accountant or a bookkeeper that it can be relied upon to provide information and financials is probably one of the things. I won't say one of the most important things, but definitely an important thing that you as a business owner should be concerned with, as an operating business, and particularly because from my standpoint and my perspective, it is something from a financing side that is heavily relied on. So if your CPA or accountant or bookkeeper is producing financials that can't be relied upon, and I can tell you from experience in banking, and in my job both as an underwriter and also as a sales individual, as a loan officer, I've seen perfect financials and I have seen not perfect financials, and I have seen ones that I just have to scratch my head and look at the individual and say, I am so sorry, we are not going to be able to help you just because your financials, I can't understand them. I can't rely upon them. They're just inadequate basically. But I've seen perfect ones to where, they give you everything you need and I never have to go back to the customer and ask them a question at all. They're two completely different ends of the spectrum, obviously, but if as a business owner, if there's one thing you can control and you want to get, and you're looking to get financing, whether it's through SBA, conventional sources, whatever, if you can control that, that is something worth controlling. That's something you just cannot kick the can down the road on. You cannot, as a business owner, even if when you're starting a business, just say, oh, I'll worry about putting together financials later. Or I'll worry about making sure that I have adequate and accurate financials 2 and 3 or 1 and 2 years down the road. That needs to be something you're doing from day one, because at some point very soon, especially if you're a startup company or if you're a company within, like for my Bolt loan example, if you're at least a 2-year in operations company and profitable, that's what we're going to rely on. We need to see tax returns and financial statements for 2 years for us to approve those loans. And if it's self-prepared or if they do not look good, And I don't mean, and when I say look good, I don't mean they're a negative. When I say look, they don't look good, meaning there's a lot of holes in them. I can tell you from experience, I've seen actual tax returns that are prepared by a CPA that the balance sheet assets and liabilities and that don't even equal, and that's a big red flag. That I can tell you from personal example, I've seen that happen. Assets total $1 million, liabilities on our equity totals $1.5 million. Well, where's that extra $500,000? Now I have to question the entire financial statement and pretty much assume that it's not good, and they're hiding something maybe, or who knows. There's some reason, and it's not probably a good one. There might be an explanation, but if that's something you actually filed with the government, I'm not even sure why the government would have accepted it, to be honest. But I've actually seen that stuff. Sorry,
If
that's a
anybody does
longer-winded way
have,
of saying I agree with what Leola said.
if anybody does have any other questions, please type those into the Q&A, and
Yes,
Frank or I will get those answered for you. Just
somebody did
wanted
have
to
a
let,
question.
oh,
Somebody did
what
have
was
a
that?
question about profitability, and I see you answered it. I wanted to use that as an opportunity just to kind of drive home what I mentioned earlier about our Bolt loans that we're doing. These are for existing companies, 2 years in now, and when I say 2 years in operations, it means that as of today, which is 10/18, you would have had to have started 10/18 or 10/17 of 2 years ago. So it doesn't have to be 2 full years in the sense of calendar years, but it has to be 2 years of operations from when you started. And the company does have to be profitable, so it at least has to be making something. But essentially, what we're doing is we're offering, or not we are, it's a bullet loan essentially. It's a term loan for working capital purposes, so for overhead, employees, cash flow, things like that. Not equipment, not something tangible. And it's for helping that company, during this time. And it's a quick loan that we can offer, and I think it's a good option for businesses. And I bring it up, and I think I mentioned it at the beginning, but if I didn't, I'll say it. Those of you on the call that might be familiar, the government is going to be shutting down in just a month from now. It's the 17th of next month. We're trying to work on as many of these loans as possible, because when that government shuts down, any SBA lending through any lender, not just us, anybody else, that will cease, because again, the SBA is a government funded program, which banks have the ability to loan and to provide to customers. Banks like ours that have a very large SBA department, that department's going to sit kind of quiet for who knows how long, until the government can kind of figure it out. After November 17th, they're going to be kind of twiddling their thumbs a little bit, wondering where their business is going to come from initially, or from that point forward, because of the government shutting down. It's what happened during the pandemic. SBA departments pretty much countrywide shut down because everything got shifted to payroll protection. Our bank was a huge lender in that space during the pandemic, assisting very small companies. We did loans, I think, anywhere from $2,000, $5,000, upwards of $100,000, mostly smaller loans to small businesses all across the country, not just in Florida. For those of you that might not understand it, SBA lending is not limited by location of a bank. So even though we're in the Florida market and we're located in Southwest Florida, we can lend SBA, we can lend all across the country, because the SBA is a nationwide product, not a local market product.
A couple of more questions on there. Are there any specific documents, programs, or apps that you would recommend to track finances? And this person says that they're new to the financial side of business.
Right. There are, for personal, there are some apps you can download. The names I'm forgetting. I actually personally use Money Wallet. Or is it Money Wallet? Sorry. Pocket Money. Sorry. It's an easy way for me to track my own personal finances. They're actually, QuickBooks is one of the more industry-wide kind of recognized products for businesses itself. And QuickBooks does have an app version as well and an online version, so you could kind of interchangeably use both. And as a business owner, it can be very easy. In fact, I think QuickBooks has this capability of being able to take pictures of like receipts and things, and it uploads it to the software platform, and you can use it both mobily and also on the internet. And also QuickBooks is something that your CPA, if you're using a CPA or bookkeeper, will support it. In most cases, will also support too. It's probably one of the more widely recognized software programs for businesses to utilize. And you can use it even for individuals, but it's primarily used for businesses. There are others, Peachtree, a few others. I'm not familiar with all of them because I'm not the accounting professional. Excuse me, but I can tell you that probably I would venture to say 75 to 80% of what we see on the financial side, the banking side, comes from QuickBooks. That's probably vastly the widely most used financial software program.
Just a comment on that. I have a team of bookkeepers that work for me and my company, and a CPA as well. But my husband and my daughter both started their own company in this last year. So we learned how to use QuickBooks because I was not familiar with QuickBooks. So you can take classes, you can find a QuickBooks certified person that can answer some questions. And that kind of ties into the next question. It said, would you recommend a bookkeeper starting out? And my recommendation would be is you only know what you know. So yes, definitely. From day one, if you're purchasing things, just setting up a chart of accounts. If you're not familiar with what that is, day two, you're already one day behind. So absolutely would recommend a bookkeeper, a bookkeeping program, any of those kinds of things, depending on what your business is.
Yeah, and I would add to that and say it also, in my opinion, I think it also is based on your revenues. Kind of my earlier comment about revenues. I think if you're, say, in the $250,000, even $500,000, maybe that's even too much. But I would say if you're in the $250,000 or under sales, you can certainly get by with a bookkeeper. And yes, everything Leola said is I would echo 100%. But I would say if you're anywhere even starting a business and starting to do revenues anywhere from say close to $250,000 and over, I would even just go with a CPA initially. And not even just bypass the bookkeeper right altogether. The cost of that CPA from day one, if you're making that kind of revenue and up, especially $500,000 and $1 million and up, it's worth the money, in my opinion, to hire a CPA from day one, set up those, as Leola said, chart of accounts, which a bookkeeper can do as well. But I would say certainly factor into that your revenue size as to who you would go to first.
Next question I have is from Dimitri. He is interested in knowing if SCORE offers resources when it comes to CPA questions. That he was given a list of vendors, but he only saw one CPA on there. And typically what SCORE likes to do is give you an assortment of recommendations, usually 3 or 4, and that way you can choose and make the best choice for you. We don't want to give you just one and say, hey, this is who you should use, because maybe it's not going to be a great fit for you. But you could go to the SCORE website, score.org, and we should have a list of more than just one, depending on where your local area is that you're looking for. And your CPA doesn't have to be your next door neighbor. Mine in the state of Maine was located about 4 hours away. And so we did everything through mail and email. And now that I'm in Florida, obviously we're about 1,400, 1,500 miles away. So the CPA doesn't have to be right next door to you. But maybe sometimes the same state is a little state tax.
The pandemic showed us one thing is that you don't have to be in the same locations anymore.
Yeah,
and in the state of Florida, we have so many transplants now from New York and New Jersey. I was doing loans
on a computer.
Yeah.
Let's see. Next one. What kind of bank would you recommend for business finances? I've been told about union banks before, and it's
credit
just
unions,
a little confusing.
Credit unions, yeah. By and large, credit unions historically have been primarily what they say credit unions is for unions. So you typically see credit unions with individuals that are military, former military, teacher, police and fire and other services like that. To be honest with you, at the end of the day, just like a business. I mean, to be honest with you, and I'll be very open with this, I've said this to many customers. To me, a bank is no different than, say, your cell phone. You've got a service with insert the blank, and it's probably good or bad, and you've had good or bad experience with any of them. Banking is the same thing. At the end of the day, my honest to God answer to that question is it comes down to you, the individual, and your relationship with that banker. I think just like you would be, in my opinion, just like you would be with, say, your realtor or, your money manager, like a, Morgan Stanley, Smith Barney, one of those, where they're investing money for you, you have to trust the individual. And you have to know that they know what they're talking about. They're a business professional. You get answers from them, you get service. I mean, think of realtors. If you're listing a house for sale and your realtor never talks to you and never isn't going out and getting bids on your house to sell, you're not going to probably use that realtor, or you're going to dump them and go with somebody else. It's no different for a bank. You want to work with somebody who is a professional, who's in your area. Probably the most important thing if you're a small business is work with a local bank. Now, I could sit here and get on a soapbox and talk about Bank of America, Wells Fargo, and all the bigger banks and badmouth them. But at the end of the day, they do the same thing that I do as a smaller community bank, even though we're a national bank because we're publicly traded, but we're a small community bank. We offer pretty much the same services. There's almost no differences nowadays from a Bank of America, Wells Fargo, Deutsche Bank, international banks, Citibank, which is not as much of a traditional brick and mortar bank as like we are, or a Bank of America, but even all the way down to us, and even community banks that are small startup. They're on one corner in downtown, wherever. They're all the same thing. The smaller ones don't necessarily always offer the same services and can't because they're smaller. They're just economy of scale. But at the end of the day, as a small business, it really, in my opinion, boils down to you meeting with people that you trust, that you can work with, that you can give information to and get answers. And, you feel like you are being treated fairly, and also receiving the service that you need. Now, that can be difficult in banking because very often in my job, I have to tell people no. I have to look at their financials and say, I'm so sorry, I can't finance whatever it is that you're looking to do. And in some cases, I have to, give them advice, saying, I'm just going to make an example. A company is leaving, they're leaving out of a lease situation and they're going to buy something to move their company into because they don't want to pay lease anymore and they want to own their location. Well, they might be butting off more than they can chew and buying something too big. And that might be my answer to them. And they might not like that. But you're working with a professional who's going to treat you and is going to be a trusted advisor. That's kind of my comment earlier about finding individuals, an attorney, a CPA, a banker, a realtor, that are trusted advisors. And that's, to me, more important. I don't necessarily think it's a slight to say you couldn't necessarily go with a credit union. If you know somebody there and they're a business professional and they can provide the services you need for your business, both depository and also lending side wise, go with them. There's a lot of reasons to pick different banks for different reasons. I could say go with us, for example, over a community bank because we're an SBA preferred lender. So we underwrite directly to the SBA. I was talking about this with Leola before everybody jumped on. We are what's called a PLP provider, preferred lending provider, meaning that if you're a small business and you apply for a loan with us, like a Bolt loan that we're doing, or the one of the ones that we're doing now, we underwrite that loan, we approve it with the SBA, and we pull that funding directly with the SBA. Whereas as community banks typically don't have the volume and aren't PLP approved with the SBA. So they have to work with a third party lender, and that's where you start paying more fees, which is why a lot of people, I think, have had a bad taste in their mouth about SBA, is because they might work with a small community bank and that bank has to work with another lender. And it's kind of a 2-3 step process. Whereas with a bank like us that are PLP, larger banks are almost all PLP. Bank of America, Wells Fargo, a lot of those banks. There are even other financial institutions that aren't traditional banks that are also approved with SBA. But that's all to say that at the end of the day, you just have to, as a business owner, be comfortable with that bank that you're working with. Get the service that you want, that you need, and don't accept, in my opinion, mediocrity or apathy from your financial institution. If they're not able to do something and you can get it from somewhere else and you can get it at the same rates and everything, then don't stay there. Leave. Your finances are important to a business.
And I know we are running just a few minutes over. I had a couple people ask for your contact information. Participants will receive a copy of all slides and the video presentation in their email. So if you could give that to them, if that's something you're able to do.
Yeah. I just need to get to my screen that has my signature line. I can send it to everybody.
Perfect. And then there are a couple other questions, totally up to you if you have time or not. I have time, but I know you're at work. So if you have an appointment, I understand that as well.
No, I'm good. I'm good on time. I'm just leaving. Oops. I gotta make sure if this is, I think, did you get that, Leola?
Is it in chat?
Yeah.
Yes, I think
Sorry, I
did.
just sent it to everybody now, I think. I
I
think I sent it
did,
to you
yes.
accidentally first, and I say there's my signature line for everybody if they'd like that. That's got my office line. It's even got my mobile, which I don't mind answering, but I'd prefer to use my office line. But email is probably the best way to get me, to be honest. Um, uh, I mentioned a little bit ago about the government shutdown. A lot of what I'm doing actually right now is assisting our Bolt loan production because of that pending shutdown. So we're trying to front load as many of those as possible before the government shutdown. So I certainly will welcome a call. Just please don't be offended if I don't answer the phone. It might be easier to get me over email, but I do understand. I actually prefer to talk to people in person. I During the pandemic, this was probably the worst of it for me, was doing stuff like this, although I've grown a little more used to it than I think I'd like. But I'm very much a people person and I like to talk to people. So I welcome a phone call, but if you do have difficulty getting in touch with me and it's an easy question, I would recommend certainly shooting me an email so I could help answer it, especially if I can help provide like a link to something or, if it's just a simple yes or no or, simple question. But certainly feel free to call me as well.
Excellent. So another question, is there a possibility for a company that was created in 2011 but started operations just 2 years ago, but it doesn't have any income yet because they were working on the creation of the plan?
Got it.
Do they have a chance to apply for working capital?
Yeah, I mean, there is. That's a long-winded answer. Just simply to say, there's a reason why the company started and why it's going to just now start to create something. With SBA lending, what you'll find is that they rely heavily on projections. So if that in that specific situation, what you just described, you obviously have something to where you probably now going forward will be able to start receiving income and actually having income coming in. Would certainly recommend that you work with either a score professional or your CPA or somebody who can help put together a business plan, but also projections for your company. Because at some point, it sounds like going forward, now that you've got whatever it is that you need to start producing income, you're going to now start having that. And you don't know what it's going to be. You probably have an idea, but the SBA does lend off of what's called projections. In my world, which is conventional world, I'm looking at backwards looking financial statements only. I don't look at forward looking. So I look at the last 2 and 3 and 4 years of financials to see how did your company operate. In your case, I would not be able to help you as a conventional lender, but as an SBA lender, I could help you because we would be relying on forward looking projection information. SBA can also look at backwards looking as well, which in the example of the Bolt loan that I was explaining to everybody, that is really what it is. That is only what it's looking at. It is only looking at the past 2 years. So that loan's example, you would not be eligible because you have not been a profitable company for the last 2 years. But for other SBA 7A lending, we might be able to provide a more traditional 7A loan for your forward-looking projection information. So yes, the short answer is yes, it is possible, but it's going to we need financial information. You got to make an application, all that stuff. You got to kind of go through the process. But yes, it is. You would be eligible.
And real quick, can you have more than one SBA loan through the 7A
Yeah,
program?
with SBA, you're capped on 7A at $5 million. You can have as many loans as possible, but you are capped at $5 million. So the aggregate of all of your SBA 7A lending has to be 5 million. And I will mention this as a caution. If you have ever defaulted on an SBA 7A loan, you are now no longer eligible to get an SBA 7A loan. I'm not saying anybody here has, but that's just a little caveat that a lot of people don't understand, and an importance of why it's important to pay your loans, specifically your SBA loans, because you default on one, it doesn't matter if you start a new company. Individually, you would be tied to that, and if you have defaulted on an SBA loan, you will then be ineligible no matter what business you start up.
Interesting. Okay, and last question. Is it possible, let's see, if possible, what would be the most important things that you as the banker are going to look at on those financial reports?
I mean, the most important thing is the bottom line. That you're making money. Really. I mean, that's the quick answer. There is more into it. There's more that go into how you're making the money and what impacts it and all that kind of, like the pandemic. I mean, that's people that give me financial statements and go, well, wait a minute, during the pandemic. Yeah, I know. I know everybody was shut down. Things were different, That's why we look at before that and now, and we take those things into consideration. But at the end of the day, the most important thing on a financial statement, whether it's a tax return or a business financial, it's that bottom line. It's are you making money? Are you profitable? Are you taking your revenues and you managing your expenses and making the most of it?
All right, I said last question, but is there a
I
minimum
saw,
credit
yeah, credit
score
score.
to apply for an SBA loan?
For the most part, 700 is about the Mendoza line, if you will. For the Bolt loans, that is what it is for us, is 700. And if you're, and not to complicate this, but if it's like a husband wife, or if it's a two partners or three partners or four partners or whatever, we take an aggregate or an average of those credit scores, and it has to be a 700. Traditional 7A loans, meaning not this Bolt loan product that we have just for working capital, but in general, yes, there is a minimum credit score. It's usually around the mid sixes. It's like, I want to say, like anywhere from 620 to 650 is about the mid, or the minimum credit score. The bigger thing to understand, and this is a longer winded answer, which I'm not getting into the total details of it, but the longer answer of that is that your credit score isn't as much of the driver. Yes, the score is a driver, but it's more of what's going on behind that score. Because if your score is a 600 or 620 and you have a bankruptcy and foreclosure or liens or whatever, that's the bigger driver for a bank, not the score itself. Banks will have a minimum in most cases, but the bigger driver, and this is even on my side, on the conventional side, it's not the score. I've seen people with a 700 score that have a foreclosure, and that may decline them for the loan, not the score, the what's behind that score. But yeah, in general, there are minimums, and I think for our Bolt loan, I know it's a 700 for ours. And for most banks, for SBA, I believe it's around mid 600.
Excellent. Well, thank you so much, Frank.
You're
Answering
welcome.
all those questions, just absolutely invaluable. I remember, just getting a real answer from a real person is very hard to do these days, and it's so appreciated. So we'd like to thank all of our participants for attending today. You will receive a video presentation in your email. We will also be sending you a survey so that you can let us know what we can do to improve, or other topics that you may be interested in. So thank you again. Have a great afternoon. And thank you, Frank, for spending your afternoon with me.
Thank you for having me, everybody.
Have a great day. Bye-bye.